Distinguished guests, good morning. I'm very pleased to open the fourth day of the Malta Maritime Summit. I would like to thank the organizers for inviting me, and a special thanks goes to John Gauci-Mestre for his unflinching energy and work in the sector he loves so much. I wish I could deliver this speech in person, but due to binding commitments as member of the ECB's Governing Council, I'm unable to attend. In my brief intervention today, I shall touch upon three issues. First, the challenges that the euro area is facing and how monetary policy is responding to them. Second, the role of regulation in enhancing the resilience of the banking sector and thus in supporting lending. And lastly, I will touch upon two areas of important reforms: the transition to net zero and digitalisation. A year ago, the euro area economy was recovering strongly from the pandemic recession. After the sharp collapse in economic growth in 2020, from the second quarter of 2021, GDP grew at a robust pace. This performance has been the result of several distinct factors. First, we had the unprecedented degree of coordination at the global and European level that led to the rapid rollout of vaccines. We had then the resilience of the banking and productive sectors in withstanding a once-in-a-lifetime shock. And thirdly, the considerable policy assistance, both from the monetary but also from the fiscal side, that supported employees' incomes and other incomes and put in place the conditions for growth to resume as soon as the pandemic restrictions were to be lifted. As soon as the health-related restrictions were raised, the demand side of the economy picked up much faster than the supply side could keep up with. Hence, the logistic problems we witnessed in most sectors, especially in transportation. In a market economy, these imbalances are expressed via the price mechanism. Just in the 12 months from December 20 to December 21, the annual rate of price inflation accelerated from -0.3 to 5%. This trend has continued since, reinforced by the energy price shock and pushing euro area inflation to 9.1% in August of just this year. For us central bankers, pinning the source of imbalance is the key to tailor an effective response. An increase in prices that is due to excessive demand should normally result in a tightening of monetary policy. A supply shock, however, leads to an increase in prices and fall in output, and with conventional monetary policy tools ill-adapted to address them. With the nature of inflation being different from the one experienced in the United States, the ECB waited until inflation showed that it began to spill over from energy to food and then across the board. The outbreak of the war in late February and the sanctions rightfully imposed by the West, together with retaliatory measures in response, shook the euro area economy again. The high European dependency on Russian gas led to a massive spike in energy prices that is still feeding through the real economy. In March, the ECB thus began ending net asset purchases, and then in July it started a rate hiking cycle that is still ongoing. As of today, policy rates have been raised by 125 basis points. Witnessing an erosion in purchasing power, households and firms are expected to seek higher wages and prices, thus embedding inflationary expectations permanently into the fabric of the euro area economy. It's not the ECB's wish to weaken the economy as a means to lower inflation, but is conscious that this weakening could lead to a short, though unwanted, recession. One of the lessons learned from the pandemic downturn is that while cumbersome for the interested parties, additional regulation and supervision, which was put in place by the central banks worldwide in the aftermath of the international financial crisis, had paid off. In that occasion, it became evident that new prudential requirements on capital and liquidity buffers were needed to enhance the resilience of the banking sector. This allowed the implementation of financial measures put in place to provide liquidity to affected firms without harming the stability of the banking sector. Benefiting from robust capital buffers and pre-crisis improvements in asset quality, banks deployed their balance sheet capacity to fill in for the sudden collapse of corporate cash flows in the early phase of the pandemic. Banks also benefited from favorable funding conditions, which have been supported by the market stabilization role of the ECB Asset Purchase Programme, APP, and PAP, and also by its credit operations, chiefly among which are the so-called TLTROs. Looking ahead, the ECB is also gearing up to enhance banks' resilience towards climate change, which the ECB's banking supervision listed among its strategic priorities for the next 2 years. Over the course of the past year, euro area banks have been stress tested against climate events. The results of this far-reaching exercise reveal that climate risks are relevant for the large majority of banks directly supervised by the ECB, as they generate income from activities related to greenhouse gas-emitting industries. How banks will adjust to climate change will have significant repercussions on the corporate sector, because banks will play a critical role in supporting the private sector's transition to net zero emissions. The last topic I would like to mention is the ongoing effort by the ECB to harness the potential of digitalisation. The ECB Governing Council has made the decision to push for the creation of the so-called digital euro. It's a complement to cash, not a substitute for it. The digital euro will guarantee citizens access to public money in the digital economy while preserving the stability role of the central bank in the payment system. While we, in the Council of the ECB, are decisively moving in this direction, the adoption of new technologies carries with it challenges and risks. Cybersecurity ranks amongst the primary concerns of us regulators when it comes to the digital ecosystem. Together with the European and national agencies, we're working to strengthen the cyber resilience of banks, financial institutions, and financial market infrastructures. Our aim is to foster private sector innovation while protecting consumers, and firms as well, from questionable or downright illegal activities. Let me conclude. The euro area has been hit by two large shocks in a narrow interval: the pandemic and the war in Ukraine, both of which triggered imbalances in the form of high inflation. The ECB is determined to bring prices in line with its mandate over the medium term, because low and stable inflation is best conducive to real economic growth. We are committed to act to ensure that inflation comes back down to its medium-term target of 2%. While price stability remains the chief responsibility of the central banks in the euro area, we are also supporting the transition away from fossil fuels and towards the digital economy. Regulation and supervision remain important tools to support private sectors in such far-reaching developments. In this respect, the contribution of the private sector is key. Regulators need to establish a dialogue with stakeholders like yourselves in order to seek a balance in the decision-making process, which will ensure continued prosperity that we have experienced so far. I hope that this conference will develop this much-needed dialogue. I wish you all a productive day of discussions. Thank you.